Okay, welcome back and welcome to Chapter 11. Give me a check mark, let me know, make sure you're here. So for this chapter, we are going to start with the self-test. Have your self-test answers ready because we're going to do all the polls we normally do. I'm going to go through as much of this chapter as I can. A lot of it's going to be very fast because it's going to be very similar to what you've already done. Once you see how the tax slips work and where the numbers go, it's going to be a lot of the same things over and over again. So we don't have to worry too much. I'm going to spend not that much time on the things that are just, here's a slip, here's a box, put it on the return. I'm going to spend more time on a couple of the really complicated issues. So we'll be delving in with early spousal withdrawals. That is important. There's not a lot in the textbook, but you do need to know how to do them. I'm going to give you an exercise for that. We're going to be doing a lot of time on transfers because they're difficult and challenging, and we're going to do a little bit of time on pension splitting because they're common and there are a few little things you need to think about that you may not have picked up from the book. So that's the plan. We'll do as much as we can do today, and then we're going to finish the rest of it next class as well. So I'm going to go through my slides here. We're going to talk about lots of different sources of income. We're now talking about the income that happens after you retire. And then we'll talk about at the end of it some credits that are connected to it. But let's do the self-test first. Before we move on, let's make sure we know what we've already covered. So I'm going to read it first. We have Wayne and Stephanie. They separated in December. Wayne moved out, but he continued to pay rent on the apartment that Stephanie and their daughter continued to reside in. At this point, you should be talking about an eligible dependent checklist. Pull one out and read the rules on the eligible dependent checklist carefully. So if you've already done this one, this is a tricky one. It's one that I would have looked up to double check. So we have a separation and we have a child. Wayne buys clothing for their daughter. He gives Stephanie money occasionally. He's paying some rent. They don't have a written agreement and they don't have a court order. So this is all voluntary. Stephanie would like to claim the eligible dependent amount for her daughter. Can she do it? So let's try this one. I'm going to open the poll. You have a 50-50 shot, so even if you're not sure, give it a try. See if we can get everyone to lock an answer in. So we have to think about who qualifies for the eligible dependent amount, when can they claim it. Okay, still waiting for a few people. Ten seconds left. Let's see how we did. So split class is what I normally see on this question. The correct answer is no, because remember that there is a rule: you cannot be supported by or supporting the person who was your spouse unless you have a written order or court order. So a court order or written agreement would mean that you could have an eligible dependent, but this is voluntary. So in the circumstance where it's voluntary and it's optional and it can start or stop at any time, there are no eligible dependent claims for either of them. And if you weren't sure about that one, you have to look at the first rule on the eligible dependent checklist very, very carefully. So we'll talk a bit more about support when we get to the complicated family chapter. But that one is one that usually trips a few people up, so that's why we tested you on it. All right, we'll try the next one. This one I'm expecting you to do well on because we did a lot of practice in class. Melina and Heen have been dating for years. They moved in together in March 11th, 2021. Marlena then gave birth to their first child on July 23, 2021. They are still living together. What is the date they become common law? So you have four options. There's March 11th, 2021, July 23rd, 2021, March 11, 2022, and July 23rd, 2022. Let's see what date you think they became common law. When they're filling out their RC65 change of marital status, what will they put as the date their marital status changed? Okay, again, I've got about half the class done and a few people still waiting. And use short periods of time because you're supposed to do these ahead of time. If you're not sure when the self-tests are due, you have a calendar or a schedule. If you don't have your schedule, if you didn't get it or you don't know where it is, send me an email and I'll send you another one. Let's see how we did. Overall, pretty good. March 23rd. So remember, common law is 12 months after you move in together, which would be March 11th, or the date you live together with the child, whichever one is earlier. So what is the date they live together with the child? It is July 23rd. July 23rd, they live together with a child. They become common law July 23rd. How long do they have to file their change of marital status? What is the deadline for their change of marital status? So marital status changes on July 23rd, 2021 until the end of the next month. Excellent. So they have until August 31st, 2021 to file their change of marital status. And that will be important if they want to have the correct amounts for Canada Child Benefits, if they want to have correct amounts for GST. Any benefits that are related to family income will change because their marital status has changed. And so you want to make sure they're getting the right payments starting right away and not waiting until it gets adjusted at tax time. All right, we have Jared. Jared has hair plugs. He wants to claim the cost of them because he considers it a medical procedure. He has not been in an accident or suffered from disfiguring illnesses. You would have needed to look this up in advance to get the right answer. Probably. You could guess, but I would look it up anyway. But let's see what you came up with. Can he claim it as a medical expense, yes or no? And it says you have 5 minutes, but you should only have one. I didn't update the remaining time. So I'm going to say 30 more seconds. Get your answer locked in. Right, 15 more seconds. Still waiting for a good number of people. This is the only time we're going to do this, so I want to make sure we all have a fair chance. All right, let's stop the poll there. See how we did. Almost all of you said no. If you said no, you are correct. So because it is not medically necessary, because it is considered cosmetic, it will not be claimable. Some people will be able to claim the cost of hair replacement if it's medically necessary, but most of the time cosmetic procedures are not. Remember, clients will bring you all kinds of things that they feel very strongly should be claimable as medical expenses. And you may agree that they should be claimable as medical expenses. I see receipts that I would very much like to put on a return. These get audited all the time. So if they're not on the list, don't put them on the return. All right, next one. Sarah uses a wheelchair and has Form T2201 certified by the CRA. Sarah would like to claim the costs of installing a mobility lift in her house as an expense on her tax return. How can she claim it? So only as a medical expense, only as a home accessibility expense, as one or the other but not both, as both of them on the return at the same time, or she can't claim it at all. Find my correct poll here. Let's see what we think. We just learned it, and we just gave you an example, so hopefully you'll all get this one right. So if you're not sure of the answer, think about the case that we just did. They had a stair lift. Where did the stair lift go? Okay, same thing. I can see that there is a certain number of people who have these answers, and there are a couple of people who aren't answering the polls. Please try. You'll learn more from attempting the questions rather than having me give you the answers. A couple seconds left. Hit the submit button. How did we do? So, a mobility lift, absolutely eligible. It is not something that's going to increase the value of your home. They're not very cosmetically pretty, and they're pretty much only necessary if you have a wheelchair or a similar mobility impairment. She can claim it as a medical expense. She can claim it as a home accessibility expense. So the question is, can she claim either or both? And the answer is she can claim, oh, where's my question? Both. You can claim both simultaneously. So it's a medical expense because she has a disability. She's a qualifying individual, so it's qualifying an expense for the home accessibility tax credit. There are two separate tests. Apply the tests every time. If you're doing one, apply the test. If you're doing the other, apply the test again. And then because she qualifies for both of them, we can put both on. In this case, we can double dip a little bit. We can claim the same receipt twice. All right. Last one. Eric has Form T2201 on file with the CRA. He has a receipt from a retirement home that indicates $9,500 of his fees were spent on attendant care. And if I can find the right question. So is he able to claim both the disability amount and the full amount of his attendant care fees on his return in this question? So attendant care, $9,500. He has a disability certificate on file. Can he claim the full amount of attendant care and keep his disability amount? Okay, still waiting for a few people. We have 20 seconds left on the poll. Excellent. I can see more people participating on this one. It's helpful for me, too, to see how you're doing. So how did we do? A little bit of a split class. What is the maximum attendant care you can claim to keep disability amount? What's the largest amount? 10,000. 9,500 is more than 10,000. Is less than 10,000. Sorry. 9,500 is less, so he can claim all of it and keep his disability amount. The answer was yes. Okay. What if the attendant care had been 15,000? What choice would we have to make then? We can choose to claim 10,000 of it and keep the disability amount, or we can choose to claim 15,000 and lose the disability amount. What if his attendant care was 15,000 and he had income from employment and the attendant was needed to help him do the work? Then what option would I have? So now I have the same person, same receipt. We can claim all of it on what line or under what deduction credit, non-refundable credit? Where would it go? What are we thinking of? It is a deduction. Disability supports deduction. He can claim disability supports deduction. So disability supports deduction. If I claim $15,000, what happens to his disability amount? So I've got the deduction of $15,000. What would happen to the disability amount? Do I get to keep it? Yes. That would be a way to claim all the attendant care and keep the disability amount. All right, and Kendra can claim primary caregiver. He probably wouldn't be claiming primary caregiver, but somebody else might be claiming it for him if in addition to the attendant. So the attendant is getting paid to care for him. But if there's another person, a friend or family member, who is filling in the gaps when the attendant who he's paying for isn't available to do it, and they do it for 90 days, they might be eligible to claim primary caregiver for him. But it is good to think about the provincial credits. Okay, so that's our summary of everything we've done up till now, including medical expenses. I know it's not enough practice, but you will get enough practice. So everything you see in the next part of the class, whether you're doing it on the computer section when we're doing that, or if you have it in the next couple of cases, spend a little bit of extra time thinking carefully about your dependents and thinking about your medical expenses. I will be giving you, not this class, but after we finish Chapter 12, I will be giving you a little breakdown, a little chart of personal credits, common federal personal credits that might help you with your studying. You're going to have to come up with a similar one, a way of organizing your provincial personal credits, including your medical ones, because there are a lot of them. And the more organized you can be with your studying, the easier this is going to be for you. So let's switch gears now and switch into retirement. So now we're going to talk about what happens after people retire. What types of income do they get? What options do they have for that income? I'm going to start with old age security. So old age security benefits are paid to eligible Canadian residents age 65 years or older. They have to have resided in Canada at least 10 years to get them. And if they have resided in Canada at least 40 years, they will get the full amount. There's a new addition to this, so if you knew that already, the new addition is that starting in July 2022, if you're 75 or older, you get the full amount plus an extra 10%. So you get whatever amount you were getting. So if you didn't get the full amount, you get whatever you were getting, but they'll add 10% to it on top of that. In 2021, the full amount was $7,486.71. One thing we're not going to cover in this chapter, but you should consider, is that there are additional things that may have gone to seniors that might be taxable from COVID-related benefits, extra seniors bumps, provincial ones in particular, that'll be taxable. If you have one of those, it'll be reported on a slip. When you get the slip, you're going to read the box number and put it at a line it tells you to put it on. But most of the government benefits for seniors were taxable. Not all, but most of them were. Okay, so if you have OAS, you're going to get a slip called the T4A OAS. You can find an example of that in the Tax Academy reference book, or you can find it in your textbook. You're also going to see it in your cases ongoing as we deal with seniors' income. On the slip, you're going to have a number of lines. So box 18 is the net amount of OAS paid. That's what goes on the return on the income line for old age security. So you can memorize that it's line 11300 if you want. I don't recommend memorizing it. Remember that it's income and find the line on the income page that says OAS income, and that'll be where it goes. You might have received more than the net amount. In that case, you'll have a box 19. That doesn't need to go anywhere. If you overpaid your OAS and you had to pay it back, so if they gave you too much money and you had to pay some of it back and you did pay it back during the year, you will get a deduction on line 23200. That amount will be reported in box 20. That means it's something that's already happened in advance. You might qualify for supplements, guaranteed income supplement. If you do, you'll have a Box 21. That's going to be treated in the same way that other social assistance is treated. So it's going to go on the return on line 14600 and come back off again. It is reportable, but it is not taxable. So you have to put it on the return for total income and take it off at the end for taxable income. And then some people will have tax withheld from OAS. It's not automatic. You may need to ask for it to be withheld. And if it is withheld, it's usually a small portion, so it's usually 10%. So look for a Box 22. If it's withheld, it'll be there. All right, you might also qualify for the Guaranteed Income Supplement. So this is connected to Old Age Security. If you are getting Old Age Security, you can also apply for this, and it will be an additional supplement. It used to be you had to apply for this every year. You had to file a separate application. We still have some clients who either remember doing that or had heard that that was a thing that they thought they were going to have to do when they retired. So we still have some clients coming into our office sort of in the summer going, oh, I need to apply for my Guaranteed Income Supplement. Can you help me? How do you get Guaranteed Income Supplement now? So the new system, what do you have to do if you want Guaranteed Income Supplement? It's all done in one step. What do you have to do to get any benefits from the government related to your tax return? You have to file a tax return. So that's it. Just file a return. Once the return is filed, they have already applied for GIS if they qualify for it. They don't need to do anything else. Okay? There is one exception to that rule, and that is if you had a client who received some COVID benefits that they weren't supposed to receive, or possibly received a lump sum that is taxable and reportable, it'll increase their net income, but was a unique situation that only happened 1 year, it's going to reduce what they're going to get for next year for OAS. If that's not going to be an ongoing source of income, you can file an application to ask for them not to include that portion of the income in their calculation for next year's OAS, because you know that next year they'll be entitled to all of it. So that is one thing we do help our clients with, is an application to ask to not include something in the calculation for next year's GIS amount. But generally speaking, tax return determines what your GIS is going to be for next year, if you're going to get it. Okay. They're not taxable, but they're reportable. Goes on the return, comes off at the end. Now, you have the option of delaying when you receive OAS. So you're eligible for OAS at 65, but if you don't want to receive it, you can choose to wait up to 5 years. Once you turn 70, you have to collect it if you're entitled to it. Okay. For every month that you delay, you get an additional 0.6% per month. If you delay the full 5 years and you don't start collecting it until you turn 70, they will add 36% to your income from OAS by waiting. Why would the government reward you for not claiming your OAS income up front? Why is it a good idea for them to have people wait longer before they start taking their OAS income? Judy, it saves them. They can use it. They can invest it. They can make more money based on it so that they will be able to afford to pay it out later. Remember, in Canada, we have a workforce that is starting to retire. We're having more and more people who are now qualifying for government benefits as seniors, and fewer people working to pay into the programs. So they need us to keep the money in as long as possible. They give us this incentive. What reason would a client have for choosing to delay getting their old age security? What are some of the reasons they might want to wait? Well, what if you have a lot of income? So Judy, you're right. If you're still working, maybe you have a lot of income and you don't need old age security right now. Maybe you're going to need it in a couple of years and you'd like to get more in a couple of years and have a little bit less now. So that might be one reason. The next reason you might is going to be on my next slide. So remember, there is an old age security clawback. So the clawback for old age security applies. If you have large income and you are receiving old age security, you have to start paying your OAS back. So maybe you have enough income either from employment or from other sources, from investment. Maybe you have a small business, maybe you have a rental property, maybe you have some foreign pensions coming in or other pension income. If you don't need your old age security right now and it's going to be clawed back anyway, it might be better to delay receiving it in the first place. Now, if you elect to receive the OAS and then you go, oh, I didn't realize I could have delayed it, I would like to delay it and get more, you can do that, but you have to pay back everything you've received within 6 months of asking. So if you start collecting it and then you change your mind and think you shouldn't have done that, as long as you pay all of it back right away, they will allow you to be considered to have deferred receiving it. Even though you got a little bit, you paid it back. And that way you can still benefit from the extra portion. Okay. But if you took money out and you kept it, and then you said, oh, I'd like to stop claiming it now, and then you wait a couple of years and you claim it in a couple of years, you're not going to get any extra, so it's not worth doing that. All right. For the clawback, how much do you have to claw back? Well, the repayment threshold starts at $79,845. So every dollar over that amount, you have to pay back 15% of your net income to a maximum of all of your OAS benefits for the year. You calculate it using the worksheet for the return. I'll show you that in a minute. And the social benefit repayment is entered on line 42200. So you have to pay it back. It becomes part of the tax you have to pay this year. But because you're paying it back on your tax return, you don't have to also pay tax on that money. You get to claim the deduction on line 23500. It works the same way as the EI clawback, but the threshold figures are different and the calculation is different because remember, EI clawback is usually 30% repayment, old age security is 15%. Now, how do you find these numbers quickly? Because sometimes you need to know right away. You're juggling numbers and you want to know what the thresholds are going to be. You can use your facts and figures book for the thresholds, but I find that one a little confusing sometimes as to whether the threshold is for this year or for last year. And if I need to find it really quickly, I get a little flustered when I'm reading the facts and figures book. I think the easiest way of finding this is straight on the tax return itself. So if I go to the tax return itself, and I'm going to make it bigger, the very first place where you're going to find any social benefits repayment, if you have clawback figures you need to find, look for line 53 or line 23500 of your return. And the details for your thresholds, income over, income under, all of that stuff is right there. So you can see if it's EI income, your threshold for repayment is $70,375, and it will tell you how to find the chart. If it's OAS, so line 11300, or if it's guaranteed income supplement, line 14600, and your net income before adjustments is more than $79,845, then you have to start paying it back. Okay? So the thresholds are right there in one place. You can find it really quickly. Let's say you have a question on an exam or on an assignment and you can't remember off the top of your head what it is. I don't memorize these numbers because they change every year, but I have a rough idea. I know my clawbacks for EI are around 70. I know my clawbacks for OAS are above 78. In my head, 78 is a good number for me to remember because I need that number in other places on the return. So you have a rough idea, and then for your individual client, you can go with the number. All right, let's take a look at the federal worksheet and how that happens. It's going to look like this. Again, it looks like a lot of work to figure it out, but a lot of the things on here are not going to necessarily be relevant. So very rare that we're going to see UCCB. You might have, however, RDSP income. That's going to change numbers. You might have repaid some OAS, so then you can put that in there. Take it line by line. Use the line numbers. It tells you where to go to find the information, and then just do your math really carefully. That's going to help you. Okay. There are some rules about how OAS interacts with the Canada Recovery Benefit. So if that happens, if your client had some Canada Recovery Benefit, There is an additional set of rules for that is tied to OAS. It gets a little bit messy. If it gets really, really complicated, you can get help from a senior associate. But I do think the forms in this case are helpful. We will see over a couple of years, as COVID benefits disappear, because they're not going to be around forever, that the forms will simplify again. But for right now, the social benefits repayment for the OAS clawback is a little bit of a beast to calculate, so it's good to practice one. You should have an example in your book as well. Okay. Other thing you need to remember, very important to tell your client, if they had an OAS clawback, what happens to their income next year from OAS? So this year, the government paid them more than they should have, and they had to pay it back on their tax return. What will happen to their income next year? It's going to decrease, and your client may not expect that. This hit a lot of our clients after the COVID benefits happened. So we had a number of senior clients who, for varying reasons, applied for a lot of CERB, a lot of COVID benefits that maybe they didn't qualify for, but somebody gave them bad advice or told them they should file for this. And they were on old age security, and they had guaranteed income supplement, maybe a little bit of other pension income, maybe some CPP. And all of a sudden, they added $18,000, $24,000 taxable income to their return. First of all, they got hit with a really big tax bill. And then what happened after that, because they weren't aware, is next year, they no longer qualified for a guaranteed income supplement, and they might even have qualified for less OAS flat out as well. And so what you would have is clients who get a large amount of money, probably spent the money for varying reasons, and then next year are relying on income that is not going to come. So again, I want to remind you, in that scenario, you do have a request for them to notice that that should not have been paid and isn't going to happen again, which might help them to restart their OAS payments for future years. But generally speaking, if you have an OAS clawback, you need to warn your clients that next year will be clawed back as well. Now, the calculation for how much they're going to take back, we don't do that for our clients because it is done by the CRA, but we can give them an estimate, so we should know roughly how it works. The first 6 months are based on the income from 2 years ago, and then the second 6 months is based on the income from last year. So they'll look for previous years of clawbacks as well. There's a really good illustration in your book. So you can calculate this using a form, or you can look at illustration 11-12, and I find the illustration very helpful because it gives you a precise scenario. You can see how it works. Okay? We do need to warn our clients if that is going to happen. Okay, that's OAS. So that's one type of income. To get it, you have to live in Canada and be a senior. So live in Canada for a period of time, be a senior, you qualify for it. It is tied to income. If your income is high, you will not get it because you will have to pay it back, and they will stop giving it to you if you continually have income that's too high to qualify. All right, the other type of very common income we see is from CPP. We've talked about CPP slips before. I'm not going to spend a lot of time on the slip because you know that. We've done it. Go back and review the chapter where we talked about CPP benefit income. Okay. You can apply for it early. If you want to, you can start getting your CPP between the ages of 60 and 65. You don't have to stop contributing to CPP to do that, but you can. Remember, you have a CPP 30 to stop paying into CPP while you're still working if you are a certain age, and you can start it again if you want to start it again. You can start paying into it again if you file a CPP 20. If you don't remember that, go back and review the recording from that class as well. You do need to tell your clients if they're thinking of applying for CPP early, every month that they are early, they will receive less over time. So 0.6% less for every month before they turn 65. If they take it out the very first possible day they can, they will lose 36% of their overall CPP lifetime benefits. So that is something they need to be aware of because, again, the government, it kind of wants you to keep your money in there as long as possible so that they can continue to fund the CPP program for everyone who's going to need it in the future. And you can already tell that we're having difficulty funding CPP because we now have the CPP enhanced portion. Everyone who's working is paying extra CPP because there isn't enough right now to pay the people who are going to need to claim it. So they're going to give you an incentive to keep it in. If you take it out early, you're going to lose some of your money. Now, you do also have a choice to take it out late. And unlike OAS, which was 0.6%, even more incentive to take your CPP later. It's 0.7% per month for every month you postpone it until you turn 70. Once you turn 70, you start receiving it, which could add 42% more on top of what you would have received if you wait as long as possible. So CPP, OAS, you can't take it out early, but you can choose to take it out late. If you take it out late, 0.6% per month extra added to it. CPP, you can take it out early, but you're penalized. If you choose to take it out late, it's an even bigger reward, 0.7% for every month that you take it out late. Okay? Once you start drawing on it, that's it. So once you start drawing on it, you're not going to be able to decide to stop and then start again to get more unless you pay everything back. Post-retirement benefits we've talked about. That's what happens when you are retired, so you are receiving CPP benefits, but you are still working, so you're also paying into it. We covered that last class, so I'm not going to do it again. Remember, you can share CPP benefits if you want to between your spouse. You have to apply in advance, though, so we can't do this on the tax return. Some things we can split between parties on a tax return. We can put some income there and some income over here. For example, dividend income, we can choose to take the lower income earners' dividend income and put it on the higher income earners' return as an election if we want to do that. CPP benefits, whatever is on the slip is what goes on the return. If you have a client where they have high income and a lot of CPP coming to them, and they have a partner with low income or no income, that might be the person to advise them that they can apply if they want to and have some of that CPP income split to their other party, to their other partner. It does depend, however, on how long they've lived together. So you can only share the benefits that were incurred while you were together. So as long as you live together, whatever CPP you paid into can be split between the two of you if you apply for it. But if you have a client who worked their entire life and then much later in life got married, or maybe they got married a second time, and now they have a new spouse, they're only going to be able to share with their new spouse the portion of CPP contributed while the new spouse was in their life. So we don't calculate this. We have no idea how much it's going to be. We tell them, fill out the application with the Service Canada CPP benefits people and see what they say. All right, I want to do a little activity here. We can do this with annotation. If you'd like to type in the window, you can, or you can type in the chat window what your ideas are. And what I'd like to say, we're going to have 3 different clients come into our office, and we're either going to give them advice or they're going to ask us for advice. The first one is turning 60, and they're thinking that they might want to apply for CPP and OAS this year. What are some of the things you want to talk to your client about in order to make sure you're giving them the best possible advice? Okay, so your client's turning 60, they're thinking of applying for CPP and OAS. Ask if they're working. Not just working income, what other types of income might be relevant? Investment income, other pension income. So I'm going to say all your sources of income. Rental property, yep, absolutely. What other sources of income do they have? Think about clawbacks. Do they understand that there might be a clawback? What else? What will happen if they take it out early now? They will get less. Good. Can they take their OAS early? Oh, my annotation went away, sorry. Can they take their OAS early? No, but they could take their CPP early, but they're going to lose up to 36% if they take it right away. So maybe they don't want to do that. All things you want to talk about. Maybe they have other sources of income that will be beneficial to take now and then save that OAS or CPP for later. So lots of things to think about there. Make sure they're aware of it. Good. Now, we have another client. Your client is turning 65 next year. They're still working. They haven't asked you for advice. You've just noticed. So they have a T4 slip. They haven't told you they're planning on retiring soon. You notice what their age was. What sorts of things would you have a conversation with them about in this case? Okay, and I've got allow to annotate everybody. So you can type in the window if you want to, or type in the chat window. What sorts of things should we be talking to our client about? Ask if they're going to keep working. Good. What can they do with CPP and OAS if they don't need the income now? Maybe choose to delay it. If they're still working and they're paying into CPP, what option do they have? They can keep paying into CPP, or good, that's an option as well. If they start taking OAS and CPP, what will happen on their tax return next year? Remember, OAS and CPP can have tax withheld, but doesn't always. And if it has tax withheld, it's usually 10%. What might be different? So we now have a client who's 65 next year. They're planning to retire. They're going to start collecting CPP and OAS. What will be different on their return? They're going to pay tax. So Judy, they are going to pay more tax. I'm probably going to say it's the first time they're going to owe. Many, many clients, this is the first time in their life they will owe tax. I don't know why, but there are a lot of people who believe that when you're working, you pay taxes, and when you retire, you don't pay taxes. It is the opposite in Canada. When you're working, you usually get refunds because when you're working, you have things like RSP deductions, RPP deductions, union dues. You have tax withheld at source. You have all kinds of credits. Generally speaking, when you're working, you get refunds. When you retire, you have all of the sorts of income that have either no tax withheld or very little tax withheld. So it is very, very common that the first time you're ever going to pay tax is when you retire. And clients are not prepared for that if we don't have that conversation with them. So we're going to think about that as well. They're planning to retire. They're going to start collecting CPP and OAS. Talk about what they need to do. They might need to put some money aside to pay the taxes next year. So something really important to think about. Have the conversation with your client. It is not a good year if they're coming in and they've retired and they have less income than they had the year before, and they have already planned on what they're going to do with their tax refund, and you have to tell them they're not getting a tax refund because all of their income as a retiree had no tax withheld or very little tax withheld. This needs to be an upfront conversation. All right. So that's the main sources of income we see a lot of people have. We have OAS, which is a yellow slip. We have CPP, which is a pink slip. So if you're doing returns for seniors, you can always look for your color-coded slips and put them on top before you do your data entry. We have lots of other sources of pension income, however, and this, I will tell you, gets confusing. So what I'm going to recommend, the next thing that I want you to do is go into your facts and figures book. And I think I had this pulled out already. I want you to go into your facts and figures book, and I want you to find figure 34. This page is absolutely critical if you're going to deal with any type of pension income. So this is not income from OAS or CPP. That's government sources of income for seniors. This is pension income. It's usually tied to investments or tied to employment. And you need this because you're going to find all of that income can be reported in a number of different ways. So you're going to have lots of different possible slips and lots of different box numbers. The other fun thing is, depending on what group you're in, we're going to talk about the groups in a minute, you're going to report it on different line numbers. So this chart here sits on my desk every year, and when I have pension income and I want to make sure it's going in the right place, I can refer to my chart. This is not something I expect anyone to memorize. Save your mental energy for dependent credits and use the chart to help you out here. So pension income, depending on what slip it is and what group you're in, could be reported on line 11500, line 12900, line 13000, or in rare cases, but it does happen, it can also be reported on line 12100 with your interest and other income from investments. Where it goes depends on what group you're in. So from the top, if you're 65 or older by the end of the tax year, I am having power issues, that should fix it. If you're 65 or older at the end of the tax year, you're in group 1. Full stop, you don't need to go any further. So group 1 is the most forgiving one. You have the most benefit if you're in group 1. Related to pension income, you have more pension credits, so pension amounts if you're in group 1. If you're not 65 or older, check to see if you're in group 2. Group 2 is under 65, but the reason you're getting the benefits is because of the death of a spouse or common law partner. Essentially, it means the benefits belong to the spouse died, and now you're receiving them. So they would have been 65, so they were eligible, and now you're receiving them because they died. In that circumstance, you're in group 2. If you're not in group 1 or group 2, then you're in group 3. So in group 3 is everyone who's under 65 and is receiving the benefits for any reason other than because of a spouse's death. Okay? The groups become very important because it tells you where the income goes and whether or not you get a pension amount for it. I'll talk about the pension amount later. Okay, so let's start. You might have an RPP. Remember, RPP you pay into, your employer puts contributions in, and you might put some contributions in your paycheck. You've been getting deductions for it up until now. When you receive money from an RPP, you can get it in 2 ways. You can get periodic payments. That's payments regularly over time. Usually it's monthly, but it doesn't have to be. It just has to be regular payments over time. That will be a T4A Box 16. Or you might get a lump sum payment. A lump sum payment is Box 18 on a T4A. So if you get a lump sum all up front, it's going to be handled differently. Okay, how will it be handled? Well, if you take a look at your slip, you're going to find a T4A, and you're going to notice that RPP annuities, periodic payment means annuity. Annuity is paid over time. Is going to be every group gets to report it on line 11500, and everybody gets a pension income amount for it. If it's a lump sum, you're going to notice that every group is going to enter it as other income on line 13000, and they do not get a pension income amount. You're going to notice a pattern here. Most of the time, pension income amounts are connected to periodic payments, and most of the time, lump sums don't qualify for the pension income amount. Okay, I want you to keep that chart up because we're going to keep using it. If I have a deferred profit sharing plan, I will have a T4A with a Box 24, which is an annuity payment. In that case, what line number will I report it on? So if I have a T4A with a Box 24, what line number or numbers will I report it on? It will either go on line 11500 or on line 13000, depending on what group you're in. So if you're in group 1 and 2, it goes on the pension income line. If you're in group 3, it goes on the other income line. You're going to notice if you're in group 1 and 2, you get the pension income amount for it. If you're on line 3, you don't. So then you need to know what group you're in. Good, let's do another one. Foreign pensions. Foreign pensions are tricky. So the first thing I'm going to say about foreign pensions is every foreign pension will have a rule depending on what country the pension is from and whether or not we have a tax treaty with that country. I don't expect you to be able to handle all foreign pensions on a tax return. Some of them are going to be very complicated. I do expect you to know what to do with U.S. Social Security. So the one type of foreign pension income that I will require you to be able to do is U.S. Social Security, and that's because it's very, very common. We have a lot of clients who may be dual citizens between the U.S. and Canada, and they'll receive Social Security, so we'll talk about that. If you see foreign pension, remember that world income is taxed on the Canadian return, reported and taxed on a Canadian return. So ask your clients, if they're retirees, not just what pensions are you receiving in Canada, but are you receiving pensions from anywhere? A lot of clients believe that if they're receiving a pension from a different government, they don't have to report it on their Canadian return, and that can trip them up. So make sure you make it very clear we need to know about world income. Some foreign pensions will be tax exempt based on the tax treaty. Some foreign pensions will not be tax exempt, but they will be paying tax in another country, and they will be able to claim the deduction from the other country on their return. Now, that is tricky because you can't just take the amount on the slip of what tax was withheld. You need to be able to prove what tax was paid. What's the difference? Well, think about a Canadian tax return. On a Canadian tax return, if I had, let's just make this easy, employment income, which you're all comfortable with, and I had employment income of $10,000, and I had tax withheld on that income, my tax slip will have a box 18 with 10,000 and a box 22 with a number in it. Can I use the box 22 as tax paid? If you think the answer is yes, give me a green check mark. If you think the answer is no, give me a red X. So I have a box 18 saying taxable income. I have a box 22 saying tax withheld. But think about what happens when I file a tax return if that's their only source of income. What will happen to the tax withheld when they file their tax return? It'll be refunded, right? Their basic personal credit is more. If it's refunded, did they pay it? No. So when you're filing tax-exempt foreign pension that you've already paid tax on, if you're filing that you have paid tax in another country, you can't just take the number from the slip to say tax was withheld. You're going to have to prove that the tax was paid. We'll need something similar to our Canadian Notice of Assessment to determine how much tax actually got paid to that government and which portion of it was connected to the pension. That gets difficult, so you're going to need a senior associate to help you with that. You're going to need an experienced person because they get audited all the time. I do want to show you a couple of things that you do need to deal with, and this will also be relevant to U.S. Social Security. If you have an exempt portion and you're calculating the pension income amount, only the taxable portion will qualify for the pension income amount, so make sure you reduce your pension income amount by the appropriate amount. There is a really useful chart in the textbook for what happens to foreign pension. So I'm going to go find that. Effective tax treaties on foreign pensions, box 42. This is going to give you an idea of which countries are most common that we deal with where they have tax treaties and what happens. You'll notice that annuities and employment pensions are almost always taxable as they are in Canada. So in Canada, if you have investments or you have a pension from work, that will be taxable income. If it's taxable there, it's going to be taxable here. Service pensions for governments, most of the time, if you are a government employee and you receive a pension in Canada, it's taxable. In most other countries, it will still be taxable. There are a few exceptions. Social Security benefits are more likely to be exempt because those will be similar to our guaranteed income supplement, which is tax exempt. But you have to look at every single tax treaty to find out. Italy is extra complicated. If you get an Italian pension, go find a senior associate who's done Italian pensions before because it's really complicated. United States social assistance, Social Security, most of it, 15% is exempt. So if you have Social Security income, you're going to enter the foreign income on the foreign income line, and then you're going to deduct 15%, with one exception, which you do need to remember that the exception exists so that you can look it up. The exception is if they started collecting the pension before 1996 and they lived in Canada continuously from before 1996 until now. In that circumstance, and it's Social Security from the U.S. that they're receiving, in that circumstance, it's 50% exempt. That's not likely to happen because they will have had to have been receiving Social Security from the U.S. for over 25 years, which means they have lived a very long time. So more and more, that is not something we need to remember. As I teach this course, it becomes less important. But I do want you to remember, if you have a much older client and they're receiving U.S. Social Security, there might be a special rule that will make more of it tax exempt. Ordinarily, it's 15%. So there are examples in the book. Make sure you know how to do those. And you can take a look at the effects of the tax treaty, figure 42, if that's helpful for you. The details are there as well as in your textbook. Okay. Then we have income from investments. So remember, when you put money into an RSP, you can deduct what you put into the RSP if you have room. When do you have to start taking money out of your RSP? What age do you have to start taking money out of your RSP? You can't leave it in there forever. After 71. Put it in until the year you turn 71. The next year you're going to have to take it out. Okay? How you take it out depends on what you do with it. So one thing you can do with an RSP is you can convert it into a RIF, a Registered Retirement Income Fund. So it takes all of the money that's in your RSP, or a portion of it if you just want to do a portion of it, and it puts it in a different type of investment called a RIF. The RIF will have 3 boxes on it. Box 16 is the taxable amount. That goes on the return. Box 24 is the excess. So there is a rule when you have a RIF. There's a minimum amount you have to take out every year. You can take out more, but there's a minimum amount you have to take out. Every dollar over the minimum amount will be reported in box 24. It doesn't go on the tax return because it's already included in box 16, but that will tell you how much extra the client took out more than they were required to take out. If they took out more, they will have tax withheld on the excess. So they will not withhold tax on the minimum amount. They have to pay tax on it, but they won't withhold tax at source on it. So they'll have a portion of tax deducted. It's 10% of the excess only. So again, this is one of those times when you have income when you're retired that is either going to have no tax taken off it, even though it's taxable, or very little tax taken off it, even though it's all taxable. Something to remember. How you deal with it depends on the chart. So if I have a T4 RIF with a box 16, what line number or line numbers will I put it on? T4 RIF box 16, back to our table. What do we think? 11,500 or 1,300, depending on your group. Group 1 and 2 goes on 11,500. Group 3 goes on 13,000. Pension income amount will be different depending on what group you're in. Excellent. Okay. There are a couple of other things you could get related to a RIF. You could have a RIF that is deregistered. That one we're not going to cover in this course, so you don't have to worry about that. Believe me, if you have a client who has their registered income deregistered, you need a specialist to help them with that. So we're going to see regular reports from a RIF. If you take the money out before you retire and you're not getting the money coming out because your spouse was over the age and is taking it out, you're going to find that it's other income and you don't get the pension income out for it. Okay. You could have other annuities. So they don't have to be RSP annuities. They could be non-registered annuities. These are investments that pay out portions periodically or in lump sums. You might have a T4A with a box 24. T4A with a box 24 is an annuity. Again, group 1 and 2, line 11,500. Group 3, other income, pension income amount, depends what group you're in. You might have a T5 for the same income, so it could be reported on one slip or the other. If it's a T5, it goes in two different places, group 1 and 2, 11,500 again. If it's on a T5 box 19 and you're in group 3, now it's not other income, now it's investment income on line 12100. That's the special case that only happens in one place. That's where it happens. You could have what's called an IAAC, an income averaging annuity contract. If you have that, you don't even need to know what it is. You're going to get a T4A with a box 111 and a box 24. They're the same number. Take the box 24, group 1 and 2, do what it says. Group 3, do what it says. Or a T5 with a box 19, group 1 and 2, do what it says. Group 3, do what it says. So you don't need to know the type of income. You just need the slip. And when you take the slip and you see a box number, and it seems like it might be a pension type of thing, because it'll say annuity or RIF, that type of wording, you're going to pull out your retirement income guide and you're going to find out how to deal with it. Okay, retirement compensation arrangements. I'm going to mention that this exists. If you see one of these and there's a box 16, I'm going to tell you to go into your textbook. It's complicated. You may need to get a letter from the employer. There's all kinds of details. These are very uncommon. So it can happen. If you see a box 16, you will be able to deal with it by following the instructions in your textbook, but I'm not going to spend time on it in class because we really don't see them. If you have a refund of contributions because someone died, get a specialist to do that return. If someone died in the year, get a specialist to do that return because that's even more complicated. If you get one, this is what it's going to look like. I haven't seen one yet. So I do a lot of returns. I haven't had one yet. But if they ever come up, I know it's in my level 1 textbook. I can go to my fundamentals textbook and I will look it up from there. Okay, so we have talked about RIF income. We've talked about unregistered income from retirement. You can also keep the money in an RSP and convert it from a regular RSP to an RSP annuity. So if you take money out under an RSP annuity, you're going to have RSP income. RSP annuity, if you have a T4 RSP, you're going to have a box 16. Box 16, what line does it go on for everybody? So back to our chart. We're looking for T4 RSP, box 16. Not to be confused with a T4A box 16. We're looking for T4 RSP box 16. Line 12900 for everybody. Because it's RSP income, it goes on the RSP income line. The tricky one is whether you get the pension amount connected to that money or not, depends what group you're in. But the income always goes on the same line. So again, the chart's going to be very helpful. That's assuming you're taking the RSP income out while you are retired. So you're taking it out as an annuity, as lump sum payments. You can take RSP income out whenever you want. So we've talked in the past about borrowing from your homebuyer plan and borrowing for your lifelong learning plan. Sometimes you don't qualify for those, but you want your money anyway, so you take it out. If you take money out from an RSP, in that case, you have to pay tax on it. You're going to get a T4 RSP with some box numbers, and I want to talk about that because whether or not you can put it on your return straightforward or you have to do something special with it is dependent on what's on the slip. And this is an area that we don't cover in detail in the book, but we are going to test you on. So you do need to know it. So I'm going to spend a chunk of time today on that. And that might be the last thing we get done today. We'll see how we do. Just a reminder before I do that, you can put money into an RSP up until the end of the year when you turn 71. After that year, you will have to take it out. So you do not have a choice after that. You have to convert it to an RSP annuity or a RIF. And you don't have to take it all out in lump sum, but you're going to have to start taking it out periodically. Okay. But what do we do if you take it out early? If you take it out early, you might have an early spousal withdrawal. It only happens if you're taking it out of a spousal RSP. So now we're talking about the annuitant. Remember, we have a contributor and an annuitant. Who is the contributor? So what's the definition of an RSP contributor? Going back to our RSP section. A contributor is the person who does what? Puts the money in or takes the money out? It's the person putting the money in. Excellent. The annuitant is the person taking the money out. So if you're the annuitant of a spousal RSP, your spouse put the money in and you are taking it out. You are going to get a T4 RSP slip. It will have a box 20, 22, or 26 depending. I'm going to tell you for this course, we're not going to deal with 26s. That's a deregistration. We're not going to deal with box 20s. That's what happens related to death of a spouse. But box 22, you are going to see. You're definitely going to see T4 RSPs with box 22s. If you see a T4 RSP with box 22, what is the clue that it's a spousal RSP? What is the box number that tells you it's a spousal RSP? Box 24. If box 24 says yes, it's a spousal RSP. I now need to know whether or not any money was contributed to that RSP in the previous year, so in the tax year and the previous 2 years. Because if that happened, there's a special rule. The problem with this is when you get the slip and you download it, if you don't look for the box 24, you won't notice it. So when you download it, you're going to say RSP income, great. That income goes on the taxpayer's return because I have a slip with their name on it, and I'm done. You're not done. They have a spouse. If they have a spouse, you need to find out were there any contributions. If there were contributions, a portion of the income, potentially all of the income, will be reported on the contributor's tax return. So the annuitant took the money out, but the contributor has to report it as income that they received in the year. They didn't get the money. They didn't spend the money. They didn't make the decision, but it has to go on their tax return. The really fun part, the tax that was withheld stays with the annuitant. So think about it from a real world perspective, okay? You have, I'm going to say, Eleanor and Marco. Eleanor is putting money into spousal RSPs for Marco every single year. Marco says, great, I want to buy a boat. I'm going to take $15,000 out this year of my RSP and use it to buy a boat. Eleanor doesn't want Marco to buy a boat. Can she stop him from buying a boat? Can she stop him from taking the money out of his RSP? No, he's the annuitant. He can do whatever he wants. The annuitant, it's his money. So he takes the money out and he buys the boat with it. There's a problem. She's still putting money in. We're going to have to find out how much money she put in the tax year and the 2 years before that. And all of that up to the max $15,000 is going to be her income. And she'll pay tax on it. The extra will be his income. He may not have any other income. Maybe he doesn't work at all. He may not have to pay any tax. The tax withheld from that $15,000 is Marco's. It's his tax withheld on his. He'll get a refund. So that is a scenario that we need to keep an eye out for because it does happen and we have to catch it. Okay? If you see a box 22 on a T4 RSP and you see a box 24, you have to ask if there were contributions. If there were, you have an early spousal withdrawal. The computer will not do this automatically for you. The software will not know what to do if you don't give it the information. It doesn't know there was an early spousal withdrawal if you don't tell it that there was. I'll teach you how to do that when we do the software, but identifying it is critical. That's what you need to be able to do today. If it happens, if you notice that it happened, you have to fill out a form called a T2205. The annuitant will prepare the form, and both spouses have to keep a copy with their return. Okay? The amount that gets attributed back, attributed means it goes on the return of the contributor, is anything that they contributed in the last 3 years minus anything that was already put in their income because this is the second time that they're taking money out in the last 3 years. So I will tell you, if it's the first time that they're taking money out of a spousal RSP while there have been contributions in the past, you can handle that return. You fill it a T2205 and it's easy. If it's the second time, so in the last 3 years they've done it once before and they're doing it again, that's an easy one. You can do that one. If there's a real pattern, if it's more than 2 times in the last 3 years, that needs a specialist, because then we get into a really complicated way of figuring out what was already included and what wasn't already included, and gets really messy. But if it's the first time they're doing it, if it's the second time they're doing it, you should, first of all, identify that it happened, and second of all, you can handle that on this return. So we are going to be testing you on this. I'm going to give you a practice now. Okay? There's one more rule, which is that income attribution only applies to regular withdrawals. So if you're taking the money out because it's an annuity payment and there's a minimum amount you have to take out, the minimum portion will not attract a T2205 and won't need to be attributed back, but the excess portion will. If you run into those and it's kind of a little bit is and a little bit isn't and it's messy, find a senior associate as well. It's not common. So usually once you're taking money out of a RIF or an RSP, in that case, you're not contributing anymore because you're retired. So this happens kind of midlife when you're at that age where you want to buy things or you have an emergency and you have to take money out of your RSP. You've been putting it in regularly, but you have to take some out for some reason. We need to keep an eye out for this. So I'm going to give you an example. So Mary has a T4 RSP. She's coming in, you're going to do her return. She gives you a T4 RSP. There are 3 boxes. There's box 22, RSPs withdrawn. Box 24 says yes. And there's a box 30, which is your tax withheld. What do we need to do right now? Are we going to put $15,000 income on Mary's return? Yes or no? Or maybe. I'll give you 3 options, yes, no, and maybe. So she took $15,000 out of her RSP. Are we going to put it on? Maybe, but we don't know because we need to find out what do we need to ask. We've identified that it's a spousal RSP she took the money out of. What do we need to ask? She has a spouse. We need to ask if he's a contributor. And when we ask him if he's a contributor, we find out a whole bunch of information. We open up a whole can of worms. We're going to go into his account. We're going to find out he contributed every year. In 2019, he contributed $2,000. In 2020, he contributed $1,500. In 2021, he contributed another $2,000. And we need to find out, did she do this before? So we're also going to go back in to his records, and we're going to find out that in 2019, she also took money out in that year, and $1,000 was attributed back to him in 2019. So we need to find out how much RSP income Mary will report on her return, how much Edward will report, and who will claim the box 30. So I'm going to recommend, we're going to do this as an example together. I want you to go to the CRA, and I want you to find a T2205. So if I open up a T2205, you're going to find amounts for a spousal or common law partner, RSP, RIF, or Saskatchewan pension plan to include an income. We see RSPs and RIF. Most often we see RSPs. Get a fillable version of the form if you can. And what I would like you to do, fill in the year. We're doing the 2021 year. Fill in the name. Remember, the annuitant is the person filing it, and the spouse is the contributor. And I want you to fill out part 1 using the information that we have here. I'm going to give you all a few minutes to do that. What I'd like you to do, when you think you have an answer, give me a green check mark or drop a note in the comment section. I'm going to give everyone about 5 minutes to work on it because you're going to need a little bit of time to practice this. This is the only practice you're going to get, so it's really important you try it now if you can, because there isn't a detailed example in the textbook. So take a minute. Okay, so I'd like to go through this together now that we have the information. If you want to practice this one again, I'm going to recommend that you watch the recording. We're going to post this class. You can pause the recording. When you get to this screen, give it another try. Or if for whatever reason that's not working for you, just send me an email and say, can you please send me the exercise from class? I'll send it to you again. If you want more practice, so this was the first one we've done together. If you want a second practice question, send me an email. I'll give you a second practice question. We can do it again. But let's see how we do together. So we have the numbers in the chat window now. And what I'm going to do is give you my answers. I have to find my answers. Put them over here because I did this in my class yesterday. Give it a minute to load. And we have tax return 2021. The annuitant is Mary. Mary has to complete the T22 or T2205. Edward is the contributor. If I had a social insurance number, I would put them in for each of them. The amount from box 22 from Mary's slip is $15,000. The annuitant's starting income is $15,000. That's going to be the total amount on line 3 as well, because I haven't taught you about transfers yet, so we haven't done transfers yet. Then we need the amount that the spouse contributed in this year and the 2 previous years. So in 2021, 2020, and 2019, we're going to add together all of the contributions, and it should be $5,500. Okay. Then we can subtract the amount that he already had included in income. So remember, in 2019, she did this before once. Because she did it once before, we have to factor that in. In that year, he's already had $1,000 attributed back to income. Now he's going to get to reduce it by that much. So his contributions eligible to be attributed back to him is $4,500. $4,500 is going to go on his return. $10,500 is going to go on Mary's return. So Mary will have income of $10,500. If that's the only income she had this year, she will pay no tax. Edward, even though he didn't choose for her to take the money out, she just did it, he has to add $4,500 to his income. Okay? What will happen to the amount from box 30? What will happen to the $1,500 that was withheld from tax? Who gets that? She does. So she should file a return, and she'll get a $1,500 refund. He will add $4,500 to his income, and he will have nothing deducted from it. If you have a client where this happens over and over and over again, because believe me, we all have at least one client like that. One person is putting money in the RSP, the other person is taking the money out of the RSP over and over and over again. What advice should you give to the person who's putting the money in the RSP? Remember, it's using up their RSP room. They are getting a deduction for it, but they're having it added back into income. They should stop putting money in it. They can't control the person who is taking it out. It's their money, they've given it to them, but they can stop putting it in. What else could they do with the money if they want to have savings that will be available in the future? If they can contribute to their own RSP, they should do that because they'll still get deductions. If they can't, or they're already maxing out their own, they could put in a TFSA, put the money somewhere where when you take it out, you're not going to have to pay tax on it. That would be a nice place to put it. Put it in a bank account for them. Remember, if you put money in a bank account for a spouse, there's still attribution rules, but then you can control how much you put in and how much they take out. RSPs belong to the annuitant. The annuitant controls what happens. So we definitely had a client where this happened. He kept putting the money in, and his spouse kept saying, no, I'll leave it in, I'll leave it in. And then for various reasons, every single year they took money out again. And it just kept getting attributed back and wasting the RSP room. And they had to come up with a different tax planning strategy for their retirement because this one wasn't working for them. Okay, we're going to stop there. The next thing we'll be talking about is transfers. Transfers are very important and very difficult, so we're going to spend some time on that. We're going to talk about split pension, which is less difficult but very common. And then we're going to do the review problem. For the review problem, you don't have to do the full tax return. You can if you want to, but make sure you've done the forms that are necessary to answer the questions. So keep practicing your forms. Because there's so much we're doing on a return now, we're going to start narrowing in on the important things we want you to work on. And then next class, we'll be doing Chapter 12. Chapter 12 is going to be a little bit shorter because a lot of it is going to be review. So I'm expecting that we're going to be caught up by the end of next class. We'll be back on track. Okay. So for next class, read Chapter 12, do the review problems. For Tuesday, you'll have to have self-test number 5 done. We'll be doing Chapter 13. We're almost done the theory. So congratulations. You've made it this far. There's only a few more chapters of theory, and it's going to be a little bit of wrapping up after this. So we're going to do students, and we're going to do administrative things. And then you're going to breathe, and then we're going to start on the software. So enjoy today. I know this week is a lot. Hang in there, keep practicing, ask lots of questions, and I'll see everybody on Thursday. Okay, so welcome back to the last part of Chapter 11. We have been doing senior income, and there were a number of challenging things in senior income that we talked about in the last class. There are a couple more very important, somewhat difficult things left in this chapter, so we didn't want to push to finish it all at once and not give you enough time. We're going to talk about those last few things today. So we're going to be talking about transfers, which is difficult. We're going to talk about the pension income amount, which is fairly easy at this point compared to everything else we've done today. And then we're going to talk about split pension, which again is difficult and very, very common. We'll focus on that. We're going to finish, take a break, and then we're going to jump into the next chapter as well. So let's see how far we get. My goal is to finish all the theory for Chapter 12. We will do the review problems from Chapters 11 and 12 at the beginning of next class. So that will give you time to absorb the material that I'm teaching you today and actually practice it. There are a number of review problems, and it's going to be your last chance to practice these before we test you on them. So I want to make sure you have time to do that. So we're going to start with transfers, and I'm going to let you know there are lots of times when you can transfer money from one registered fund into a different one. And many of those transfers happen directly, and so we don't see them on the tax return. But there are some small circumstances where they may happen indirectly, and when they happen indirectly, they have tax consequences that we need to take into account. Most of the times there is an indirect transfer. It isn't going to affect you in this course because it is going to arise because of the complicated tax situation that you won't be expected to handle. Most of that happens when someone passes away and they own registered funds, and those funds are transferred to beneficiaries, or they go into the estate and then get transferred from there. So those scenarios we're not going to discuss. The rules for them are quite complicated. I'll mention a few times you're going to see it, but I don't expect you to handle that. There is, however, unfortunately, one type of transfer that you are definitely going to see and that can cause problems if you don't know comfortably how to deal with it, and that is retiring allowances. So I'm going to start with retiring allowances today. Retiring allowances are generally lump sums of money that you receive when you leave a job. You might leave because it was a severance package. You might leave and receive a package thanking you for your service for a long time when you retire with a company. But retiring allowances can encompass a number of different sources of income, and they all fall under the category of a retiring allowance. There's more details for exactly what goes into there in the textbook if you're curious. From your perspective, all you need to know is that there is a retiring allowance. So if there is a retiring allowance, there will be a T4 slip. Usually it's part of the regular T4 slip. They'll have their normal sources of income that you see all the time. But at the bottom in the other boxes, you're going to see one or two or a combination of boxes 66 and 67. Box 66 has the amount of the lump sum that they received, which is taxable income. So retiring allowances are taxable income. Box 66 has the portion of that income that can be transferred into an RSP without using any RSP room. So that is very valuable because you can have someone who receives a retiring allowance who may not have any room left for it, and these retiring allowances can be quite large. So ordinarily, if you had a very large RSP contribution and no room, what would happen on the tax return if that was the circumstance? If I have zero room and I put $30,000 into an RSP, what are the consequences of that? See our early morning answers in the chat window. There is a penalty for overcontribution, which is 1% per month that you continue to be over-contributed. Remember, if this is a retiring allowance, you've left the job, so you may not be building up more room to cover that. You may need to take it out. What is the buffer? How much buffer do I have to go over contributions on an RSP? 2,000. 30,000 is well over that, so it would be a very expensive circumstance for a client. If there's a box 66 that lets me transfer all 30,000 of that RSP, I don't need to use any room. All of it goes into the RSP. I will get a deduction for all of it on the tax return, even though I have no room. So that's what box 66 for. It's the portion that can be transferred. A transfer will allow you to put money into an RSP without having or without using, if you choose not to use it, without using your RSP room. Box 67 would be the portion of the retiring allowance that is not eligible transfer. So that portion of it is just going to be taxable income. If you want to use that money to buy RSPs, you have to have room for the excess because the non-eligible portion can't be transferred. Okay? So a couple of things here. If you have a retiring allowance that is not eligible for a pension income amount, so some people will think because it might be connected, it says retiring in it, retirement, that it may trigger something like a pension income amount. This is a completely different source of income, so it is not that. It is more considered a lump sum source of employment income. The retiring allowance is never included in box 14 of the T4. It is separate. On the tax return, you have to add box 66 and box 67 together and enter it on line 13,000. So 13000 is the line it goes on as other income. So the total portion of the retiring allowance, both the eligible and not eligible for transfer portion, have to be reported as income. Let's assume that I have a retiring allowance altogether of 30,000, got a lump sum. If I put it in as income, why would that be a problem for my client? How much tax has been withheld from the retiring allowance? Absolutely none. So it's going to be, if it's a large retiring allowance, it's going to have an effect on the tax return. We often notice it when it's a large retiring allowance and they have a small RSP room. Because if we're not careful with what we're doing, we'll put the retiring allowance on the return, and if they have a big RSP receipt, we'll put a big RSP receipt on the return, and we'll notice that we're not getting a big deduction and there's an overcontribution and it all looks terrible. It shouldn't be handled that way because it isn't supposed to use the room, which means you have done your theory wrong. You'll catch it in that scenario because it looks like there's a problem for your client, and hopefully at that point you go to a senior associate and they fix it for you. The problem with retiring allowances is not everybody maxes out their RSP rooms and not everybody gets a big retiring allowance. So what is the effect to your client if they have a portion that could be transferred to an RSP without using up the room, but you don't notice when you do the return, and you do the return normally? So you're going to enter the retiring allowance, let's say it's $5,000. They have an RSP receipt for $5,000. Their RSP room is $20,000. What is the effect to your client? What is the cost to your client if you're not careful and you don't catch that there should be a transfer? Most likely on the Schedule 7, you'll enter the RSP receipt, and then on the Schedule 7, because you haven't noticed that there was a transfer, you'll look at the RSP room and you'll say, I have enough room, and you'll take $5,000 out of the RSP room. At what point will the client find out that you have used up their RSP room when you shouldn't have? Well, they may never find out, or they may someday go and want to put a bunch of money into an RSP, and they should think they have a lot of room for it because they've never done anything that used up the room, and then they'll find out that their room was used incorrectly. This happens all the time. So what is the clue for you that you need to think about RSP transfers if you see a T4? How do you know from that T4 that you have to think about transfers? Box 66. Please look for them. This is one of those things where people get into an office and you're doing your first series of tax returns and you have a lot of things to remember. We get into the habit of trusting the downloads to do the work for us. The computer will not automatically make a transfer happen for you. If you don't tell the computer to do a transfer, it will use the room. That is the default. If you are doing a paper return and you don't notice that there's a transfer, you will make a mistake. So this is very important because it costs our clients kind of money in the sense that we are taking away deductions that they are supposed to be eligible for if we're incorrectly using their room. So let's talk more about how you actually do this. So I'm going to give you some more rules for this. You're going to have box 66 is the amount eligible for transfer. Box 67 is not. Any portion of the eligible amount can be transferred into an RPP, RSP, or PRPP, either directly or indirectly. We see it happen on a tax slip when it happens indirectly. To make it happen, what does the taxpayer have to do? They got their lump sum. The company said, here's your severance. This portion can be transferred into an RSP if you want to. This portion can't. What does the client have to do to make the transfer happen? They have to buy an RSP. So if they don't buy an RSP, what will happen on the tax return? You're going to have income from box 66. You're going to have income from box 67. And if you haven't bought an RSP, that's it. No deduction for you. So it is required, if you're going to do a transfer, if you notice a transfer was possible, find out if the client actually did buy an RSP with the money, because they don't have to. They can just spend their money. But if they spend their money, you can't give them a deduction. So box 66 is what they are allowed to transfer. The RSP receipt will tell you how much they did transfer. Good. What if I have a client who has a box 66 with I'm going to say 5,000, and a box 67 with 3,000. What if they bought an RRSP for 8,000? What will happen on the tax return? I can transfer how much? They have an RSP receipt for 8,000. How much can be transferred? 5,000 can be transferred. What happens to the rest of it, to the 3,000 extra? First, look to see if they have room. If they have room, I will give them a deduction. So anything that can't be transferred after that point in time, go see if they have room. You can still claim it if they have room. Okay? Sometimes what we get are clients who are buying receipts throughout the year. RSP receipts are coming out automatically. They get a transfer. They don't do anything specific with it, but within the year, they do continue to put money into an RSP. If you have a transfer of any kind, but the only one I'm going to teach you in this class is retiring allowances. If you have a transfer of any kind, find out how much transfer you have in that year. Find out how many receipts you have and claim as much as possible in that year as a transfer, because you want to save as much room as you can. So they don't have to specifically have the intention of transferring the money. They just have to effectively make the transfer happen. Even if it happens in lots of small payments, you don't have to have one single receipt for it. Total up all the RSP receipts you have, see how much transfer room you have, how much option you have to transfer the maximum of what they put in. So let's look at the scenario again. What if in this case I had a box 66 with 5,000 in it, and when I total up all my clients' receipts, I only have 3,000 for RSP receipts? How much can I transfer in that scenario? So box 66 says 5,000, the receipts say 3,000. I can transfer all the receipts I have up to the amount in box 66, so that's how that works. Okay, I want to talk a little bit more about direct and indirect transfers, but I also want to show you how you do it on a Schedule 7. So let's do the broad strokes first, and then we're going to come back and look at the details. And there's going to be one more really confusing scenario with transfers, so I want to cover that as well. So we talked about direct and indirect transfers. How do you know if it's direct or indirect? Direct transfers happen from one institution to a different institution, and the money never touches the hands of the taxpayer. So most of this will happen from one bank to another bank. You can transfer funds from one RSP, so you might have all your investments in an RSP with one company, maybe it's Royal Bank, and then you say, I want to switch it all over to Sun Life. They can transfer everything from one RSP to a different one. If they do it that way, it is a direct transfer. If they give you the money, if you take the money out of Royal Bank, and then it lands in your bank account, and then I use it to buy a bunch of RSPs at Sun Life, what would be the tax consequence of doing that? If I take money out of an RSP, ordinarily what happens? It's taxed. Excellent. So if I do it that way, I have to pay tax on it when I take it out, and when I buy my RSPs at Sun Life, I then have to have room. So that's the circumstance where you cannot do an indirect transfer. If you want money to go from one registered account into another registered account, it has to be a direct transfer. And trying to do it the other way, taking the money out yourself and then going to buy another one, is not allowed. So in rare circumstances, indirect transfers are allowed, and they are allowed because there are reasons why you can't kind of make it happen the other way. There isn't an option to make it happen. So for example, when you're getting a lump sum retiring allowance payout, there is no initial registered fund to transfer it from. It's coming from the employer, like pay. So that's the circumstance where the money actually does land in the bank account of the taxpayer. They then have a set amount of time to do the transfer, and after the time expires, there is no more transfer. So the contribution has to be made in the same taxation year the income was received, or in the first 60 days of the next year. So you have from January 2021 until March 1st, 2022 to make the transfer actually happen. This is where some people get confused. The RSP receipt doesn't have to be dated after the time that the retiring allowance happened, but it has to be within the same year. So again, if you have that client who's making regular contributions while they're employed, and then they retire and they get a big retiring allowance, and then maybe they use a chunk of that and they buy another RSP receipt, it doesn't matter that some of those RSPs were purchased before. You can still connect them together as long as it's in the same taxation year or the first 60 days of the next year. It will count towards the transfer. I'm going to stop there before I talk about the last point on this slide, because that's the complicated one, and I want to take a look at a Schedule 7 and show you how to do a transfer on the tax return. Okay, and I'm actually going to do this using fillable forms. If you like, you can follow along. If you have your Schedule 7, and we're going to do an example and see if we can make this work together so you see how things will look on the return. Okay, so let's say that I have, and I'm going to put some numbers in the window here, I have a box 66 with 30,000 in it. I have a box 67 with 5,000 more. I'm going to have an RSP room of let's do another number, 6,000, and I'm going to have an RSP receipt for 35,000. Okay, so lots of numbers I've typed in the chat window so you have them to look at. Let's work through this one together. So what will go on to the income line of the tax return on the other income line? How much will the income going on the tax return be? Total your box 66 and 67, and what do we get? $35,000. Good. That's going to be a significant effect. So everything in box 66 and box 67 altogether is income. It is taxable income. It goes on other income. 35,000 would be a significant impact on any client's tax return. So we're going to look to see if there was a retiring allowance. There is. We're going to look to see if there's an RSP receipt. There is. Now we have to decide how much we can transfer. So let's start with the receipt. I'm going to assume all of this happened in the middle of the year. So in the middle of the year, I have an RSP receipt for 35,000. I'm going to enter 35,000 because this is where you put the contributions. The RSP receipt will go here. Let's assume there's nothing else to make this complicated, so I'm going to say total contributions is the same. Okay. We're not going to do any repayments for any plans. Let's keep this easy. The RSP deduction limit is 6,000. So if we couldn't do a transfer, we would have a problem. We would have a large overpayment. But we don't want to have a large overpayment, so let's do the transfer. So the room is still 6,000. The contributions available to deduct from line 10 is the 35,000. I didn't fill those in. I really should have, so let me do that. 35,000 goes here. We're going to apply none of them to a repayment. Contributions available to deduct, 35,000. How much can we do as a transfer in this year? $30,000, because that's the amount in box 66. So I'm going to put 30,000 here, and I'm going to draw the line over to the side. When you see an arrow, it means put it there. Then it's going to say line 14 minus line 15, which is 5,000. Then it wants me to say whichever is smaller, line 13 or line 16. So I have $5,000 that I couldn't transfer. If I want to get a deduction for that, and I do, I have to have room. Do I have enough room in this case? Can I deduct the additional $5,000 that was not eligible for transfer? Yes, because it was under the room that I have. So I'm going to do that. I'm going to say which is smaller. 5,000 is smaller. Okay. Then it's going to say how much of that am I going to do? It can't be more than line 17. I want to deduct everything I can from line 17, so I'm going to add it in there. Then it's going to say what is the total contribution that I am making this year, 35,000. And then it says enter whichever is smaller, line 10 or line 19. And they're both the same. How much do I have undeducted? 35,000 was available. 35,000 was deducted. 0. What will be the effect on the tax return for the client? We've added $35,000 in income to the client. We've given them a $35,000 deduction. Will there be a tax consequence in this case? No. They're back to where they started. And we have protected their room. They have exactly as much RSP room as they would have had if they had done everything normally, because they made a $5,000 contribution that was not eligible for transfer. That's how transfers work. Okay? Now, it's really simple if it all happened in the same RRSP year. So if it happened in the same year, it's easy. If it happened from March to March. But what gets complicated is what happens at the beginning of the year. Okay, so going back to this slide, deduction must be claimed in the same year the income was reported. What happens for the tax slips if I get a lump sum payment for a retiring allowance from my employer in January of 2022? When will that be reported on a slip? When will I get the income portion reported on a slip? So I received income in January of 2022. When will I get the tax slip that said I got the income? I'm going to get the slip in 2023, and I'm going to file it on my 2022 tax year. Good. If I buy a receipt in January to do the transfer, because I have to do it, so I got the lump sum and I went right to the bank and I bought a receipt. If I get a receipt for January of 2022, which tax year would that normally be reported on? January 2022 would be reported on a 2021 tax year, right? So if I go back to my form here, and I'm looking here, it says enter the contributions made for the 2021 tax year that were made in January, which we cannot do, because if we did that, we would have a $35,000 contribution now, and we would not have a box 66, so we couldn't do the transfer. What's the problem if we can't do the transfer? I don't have any income that lets the CRA say we can do a transfer. What will happen on the Schedule 7? It will be taxable next year. Well, not necessarily, because it'll be undeducted contributions. But I will use up my room this year. And what will it look like to the CRA if I put $35,000 in and my limit is 6? What will the CRA think? massive overcontribution. And if I didn't notice and I wasn't careful, what I would have done, and this happens to people who don't know what they're doing with these transfers, if I didn't know that I have to keep the income together with the receipt for the transfer, they have to show up on the same year. If I put the receipt on the year before the transfer is going to show up, so the year before the income shows up, I'm probably going to use the room too. So what would normally happen if this is being done incorrectly is in 2021, $35,000 would show up on line 3. You'd notice a limit of $6,000. You'd use the room of $6,000, and then you'd have a massive overcontribution. So in that scenario, when you have a transfer, it is very important to remember the receipt has to stay with the income. So you're going to take that piece of paper that the receipt is on, you're going to put it in an envelope that says 2022 tax year transfer, and you're going to hand it back to the client and put notes in the file, and do not report it on this year's tax return. That is the correct way to do a transfer that happens at the beginning of the year. And I know it's confusing because they have the receipt. What will happen next year is you're going to enter the receipt next year as a contribution, which looks wrong, but it is the right way to do it. You're going to enter the receipt next year, and you'll have the income next year, and you do the transfer next year, and it all works correctly. So that is the correct way to do a transfer that happens at the beginning of the year. Because if you put it on the previous year, you are either triggering the use of a bunch of room, which once you've used it, you can't get it back. So you've lost the ability to do the transfer. Or you've got a massive overcontribution, and now you have a T1 OVP problem, which you're going to have to get sorted with the CRA. It can be fixed, but it is really messy to fix. So honestly, if you learn nothing else from today, what I would like you to learn is that when you have a transfer at the beginning of the year, the receipt and the transfer have to go together. I want you to mentally staple the T4 with the income together with the receipt. They get reported on the same tax return. So if the income's not going to be reported until next year, the receipt will not show up on the Schedule 7 until next year. Okay? Let's try that out and see if you're understanding everything that I'm saying. So we have Bill. Bill retired in the middle of January 2022. He received an eligible allowance, so box 66, of $15,000. He then bought an RSP for $15,000 January 15th, 2022. We have a receipt for $15,000 RSP contribution for the first 60 days of 2022. Sorry, and it should say the retiring allowance will be reported on Bill's 2022 T4 slip. Okay. So, first question in the chat window, let me know which year should he report the RSP receipt? Which year will he claim the transfer? 2022. Even though first 60 days usually go on the prior year, in this circumstance, it's going to have to be on 2022 because you can't claim the transfer until you have the income. Good. Should he report the RSP contribution receipt anywhere on the tax return? For 2021. So for 2021, should he report it anywhere on the tax return? No. Okay. If you've got that and you practice one or two transfers, we do have problems where you can practice them. You will know more than a lot of experienced associates do because transfers are difficult. Most important, please look for them. On a T4 slip, we get into the habit of letting the computer download it and just going, yeah, that looks fine, and not checking to see if those other boxes are there and if they mean anything. The computer will not automatically do a transfer for you. You'll put in the income, you put in the receipts, the computer will use up the room, and that's it. So you have to be looking for these. They do happen. So every time I've taught a course and I've had an associate say, oh, I did 300 returns last year, but I never saw one of these, I would bet you just about anything, if I went back to the files and I looked at all 300 files, there probably were one or two, at least one, I would say, every year, box 66 or 67 that they missed. They don't know they missed it. The client may never find out that you used up a bunch of their RSP room, and you shouldn't have, but it means that they have fewer options to claim deductions in the future. You are taking money out of your client's pocket when you do this, so make sure you're catching them. If you catch it and you're not sure what to do with it, get help. But if you don't catch it, then we can't fix it. So keep an eye out for those other boxes on the T4, and remember transfers. All right, I'm going to go through really quickly now other indirect transfers. However, I want you to notice anywhere in the textbook and anywhere on my slides where it says amounts received on death, you should not be doing that return, because in the year that someone dies, there can be a lot of movements of assets. So retirement, investment assets, things like that. And there's a whole course on what to do with what happens after someone dies, and a lot of really specialized rules. So we have the rules in the book, but don't spend a lot of time studying them, because we don't expect you to do returns for people who died. This is just to be aware of the fact that other transfers can happen. And if you see any of these box numbers on a T4 RSP slip, or on any slip that says refund of premiums or received on death, any of those triggering words are going to tell you that somebody died recently and they need a specialist to do that return. And that's all I expect. So you might receive an amount on death of an RSP annuitant, so someone who had an RSP annuity or just had an RSP and then they died and it went to a beneficiary. They will have a box 34. There's an election that you can make for how that's going to be taxed. I'm not going to cover all the details of that. Go find a specialist for it. Some of that money can be transferred so that it doesn't end up being taxed. Again, you should not be doing that return. It's going to create problems, but it does exist. Similarly, there can be indirect transfers on the death of a RIF. So if someone dies and they give the money to someone else, it can go as an indirect transfer. That is an option, but if it does happen that way, outside the scope of this course. Okay. Other ones, generally, lump sum pension can only be transferred directly. So if you have a registered pension plan from work and it's being moved into an RSP or a RIF or some other vehicle, generally speaking, it has to be direct. If it's done by giving the money to the taxpayer, then it will be taxed and you'll need room, with a few exceptions. There are some exceptions if you have a lump sum from a non-registered plan that you were entered into when you weren't a resident of Canada, because you couldn't get a registered plan because you weren't a resident of Canada. There's a few exceptions for that. That's not going to be covered in this course. We see that most often when we're dealing with newcomers to Canada or immigrants. Whole other course for that. You might see a box 22 of a T3 slip. If you see a box 22 of a T3 slip, go find a specialist, because there may be an option for an indirect transfer there. Some lump sum DPSP payments, again, if you see a lump sum on a DPSP, you're going to need to do a bunch of research, get some more information, go find a specialist on that one. And then one we do see are lump sum payments from IRAs. These are American retirement funds. So the IRA is kind of similar to our RSPs, but it is American. It's pretty much impossible to transfer directly from an IRA into an RSP, so it has to go to the taxpayer, and there are some allowances for a portion of that to go as an indirect transfer. Those ones, I'm going to tell you, get really, really messy, because there's always a withholding portion that has to be adjusted for, and there's currency conversions, and it's just a huge big thing. So make sure if you have one of those, you go find a specialist who deals in U.S. tax returns, who can help make sure that it's handled correctly on both sides of the border. So retiring allowances, I want you to know how to do. You're going to see them at some point. You have to make sure you know how to do those transfers. All of the rest of these, identify that it is a problem, there might be a transfer scenario, and make sure you go find someone who can help with it. All right, that's the first big thing that we had left in this chapter. We're not going to take a break. We're going to finish the chapter. Let's do an easy one. So, age amount. By now, we've done lots and lots and lots of non-refundable credits that are tied to income. This is a personal amount that's tied to both income and age. So, every taxpayer 65 or older has a potential non-refundable credit. It goes up every year, so you don't have to memorize the number, just know where to look it up. For 2021, it's $7,713. And then, if your income is below $38,893, you get the max. Every dollar over that, you have to reduce the credit by 15%. And that means that when your net income is $93,313, at that point, you've run out of age amount. You don't get one anymore. It's calculated on the worksheet of the return. Do the worksheet. Claim it on line 30100. How will you know that your client has an eligible age amount? What is the clue? This is more a practical how to not make mistakes on your assignments and on your review problems. Check the date of birth. So if you remember way back at the beginning of the course, I said I mostly don't care what age my clients are except for a couple of years. I always need to know when they're 18, 19, 60, 65, 70, and 71. Those are the years that I try to make sure I know which birth dates I'm looking out for, because those are the times I have to stop and think there might be something here that I have to deal with. So 65 or older, remember to check the date of birth of your client when you're preparing your return. They might have a credit that they're entitled to. You'll find provincially that there are similar age amounts with the same restrictions. So it's going to be based on their age, which will be 65 or older, and then it will have a set amount that will be reduced by a percentage of income over a threshold, but it's going to be done exactly the same way. You'll have a worksheet provincially and just plug the numbers in the worksheet and see what you get. Easy? I want to give you something easy after doing transfers, because transfers is hard. Okay, here's another relatively easy one, which is the pension income amount. So we talked about a lot of pension income in last class, sources of pension income. And if you remember, on the chart we were using to determine where the income goes on the tax return, there was a column that said pension income amount. If the income had a yes in that box, based on their group, so it might be different for the same income, depending whether you're group 1, 2, or 3, whether you're 65 or older, under 65, but receiving the income because of the death of a spouse, or everybody else. If there's a yes in that box, then that income qualifies for the pension income amount. If there's a no, then it doesn't. How much you get is the smaller number of either all of your pension income that qualifies, so every type of pension income that has a yes on it, or 2,000. So all your pension income to a max of 2,000. Good. Just to see if you remember, what will we put if we have U.S. Social Security, which I'm going to remind you is pensionable, but portion of it is exempt. Remember, 15% of U.S. Social Security is usually not eligible. What will happen to the pension income amount for U.S. Social Security? Do I get to claim all of it or only a portion for the pension income amount? I will give you an example. A portion. Good. So if you have $2,000 converted to Canadian of U.S. Social Security income, and that's the only pension income you have, how much will that person's pension income amount be? So I have 2,000 Canadian dollars worth of U.S. Social Security income and no other source of pension income. What will that client's pension income amount be for the year? $1,700. This is one that we forget because usually when I'm calculating what's eligible for the pension income amount, I go down the income page of the return and I go, that's eligible for the pension income amount, that one's eligible, and I go down the list. I might, and I have done this, but not on an actual tax return, but when I was taking this class, might forget to look for a portion that's exempt, if it's exempt because it's foreign. So make sure you're deducting anything that's exempt before you calculate your pension income amount. Most of our clients, if they have income that's eligible for the pension income amount, will have more than $2,000. So they'll just claim the max, but not all of them, so we have to check. Good. Are CPP and OAS eligible for the pension income amount? No. So keep that separate in your head. CPP and OAS is a type of income you get when you are retired. CPP has the word pension in the name. However, OAS and CPP are never eligible for the pension income amount. So if you want to calculate the pension income amount, go down your list for the reporting guide, look at the columns that say what is and what isn't eligible, and don't add in things that shouldn't be added in. Okay, so the pension income amount is good. Remember though, with senior taxpayers, it's not a huge non-refundable credit. So senior taxpayers still aren't usually in a position where they have tax that either has nothing withheld from it or a little bit withheld from it. What else do they lose when they stop working? What other non-refundable credits do people who are working get that people who are retired don't get? Think of all the non-refundable credits you know. They don't get the Canada Employment amount, the $12.57. Good. If you're not working, are you paying into CPP or EI? Nope. So there's a large portion of the return that you've gotten used to calculating on everything that all of a sudden you're not going to have numbers on those lines because they are retired and they are no longer working. And the best they're going to get is maybe some age amount and $2,000 pension income. Do you think they're going to be owing or getting a refund in most circumstances? Owing. Yeah. And we'll talk about that more in a minute. So I want to talk about a few things we can do related to pension income amounts and also pension income, and that is pension income splitting. This is very, very common. I'm going to tell you right now, you will never do this by hand. So we're going to have you fill out one form by hand so that you can see how the form works. But in real life, there are too many moving pieces on the tax return that are affected by the income numbers that we would never be able to calculate personally, or be very challenging to personally calculate what the best pension income split is for a couple without having a computer program to do the maximization for us. So think about all the things that change when you change income. Changing an income amount can affect a spousal amount. It can affect elder dependent amounts. It can affect caregiver amounts. Anything tied to income will be affected from income splitting. It will increase some credits. It will reduce other credits. It'll do all kinds of things on the tax return. And so actually doing this in real life is something that we leave to the computer to an extent. So the computer will decide what the best options are, and then from that we may need to make some additional decisions, and we'll talk about those as well. However, it is good to know what the maximum is so that you're not splitting more than you should be, and it is good to know how the form works in the event that you have to do an adjustment. So you know what number you want to split, but you have to do an adjustment. You may do that one by hand. Okay? So still practice them anyway, but remember, in real life, trying to come up with the right number is not something we're going to test you on or ask you to do, because we would never do that without the software helping us. What can you split? Well, you have a choice to split up to, so the maximum is 50% of the eligible pension income reported on the spouse or common law partner's return. So you'll take one spouse who has pensionable income, and the most that they can transfer is half of whatever is eligible for the pension income amount. With a little star, we're going to talk about retirement compensation agreement, RCAs, sorry. We're going to talk about those later. But generally speaking, anything eligible for the pension income amount is eligible to be split. Okay? You could have two people, both of whom have pension income, and you can choose which direction you want to split it in. You would never split it both directions because it's a lot of paperwork that's unnecessary. Just split the amount you want from one person to the other. Don't have money going in both directions. It's just unnecessary paperwork. You don't always have to split from the higher income spouse to the lower income spouse. Sometimes you might want to split some of the pension in the other direction for a number of reasons. And just because couples have a certain type of split one year doesn't mean they have to do the same thing the next year. So we will see sometimes they'll do a pension split one year and nothing the next year. Sometimes we have couples where, because most of their income is both from retirement pension but also from investments, and their incomes are close to each other, we'll find that one year one person will be splitting to the other, the next year it goes the other direction, so you can always choose one way or the other. It is an election, so it is optional and not necessary, and the amount that you pick is optional as long as you don't go over the max allowed, which again is 50%. Let's talk about the terminology. So we have the transferring spouse, who is the person who has the pension income that's eligible for the pension income amount, who is going to transfer it to the other person's return. They will have all of their income reported on the first page of the tax return, so they still report everything as normal. And then when they do the transfer, they will have a deduction for the portion that's being transferred. Okay? They have to have a spouse, and they have to be resident in Canada at the end of the year or have been resident in the year before they died, and they have to have income eligible for the pension income amount. So those three things are always going to be true. You can't split pension with a spouse if you don't have a spouse. That's important. Okay. Who can receive it? Again, they have to be resident in Canada at the end of the year or have been resident in Canada before their death. They have to have had a spouse or common law partner. They have to have been a spouse or common law partner of the person who's giving them the money at some point in the year, at any point in the year. And at the very end of the year, they have to be living together or basically not be living apart for 90 days or more due to the breakdown of the relationship. So they can't be separated at the end of the year. What are some reasons why they might not physically live together, but they'll be able to do a pension split? So what are the circumstances where you might have a client who's not physically living with their spouse, but they're still going to be able to do a pension split? Health is the big one. So we definitely have some clients who might be in a long-term care home, or they might be in hospital for a long period of time. So if they're separate and apart, and that's the reason why they're not living together, not because the relationship is broken down, you can still do the pension split in those cases. And I did say there was a special rule for RCA. There's a section for pension income where you have to deal with what happens. Distributions from an RCA, they are identified in box 17, are eligible for pension splitting, but not for the pension income amount. And then there are limits on that. This is complicated. They're not very common here. So if you see an RCA, do what I would do, which is go to the book and learn about it then, because you have a lot of stuff to learn in this course. Know that the information is there to access if you need it, but for now, I would like you to focus on what we see more often, which is sources of income that are eligible for the pension income amount. Okay. How do we make the election? You need to fill out a T1032. You need one for each tax return. So this is really fun in an office, because in an office we do 3 copies of everything. 1 copy for us, 1 copy for the client, and 1 copy that we can send to the CRA if they ask for it. Which means if you're doing a split pension, you have 6 copies of the same document. And they all have to be signed by the same 2 people. So 2 signatures on 6 copies. I make a little, on my desk, conveyor belt. I have a stack of documents, and we just pass them around in a circle, and when they come back, I make sure they're all signed. So A lot of paper on our end so that the CRA doesn't have to have any paper on their end. In order to do it, couples can split up to 50% if they're only living together part of the year, and that's either because of a separation in part of the year, or maybe they got married partway through the year, or became common law partway through the year, or maybe one of them died. Then the split that they can do is prorated. So they have to know how many days they were spouses, and then they'll be able to claim that percentage of the 50% that's handled on the return. So if that's confusing to you, if you fill out the return and you just answer the questions on the forms, you'll end up with the correct proration, but it does limit how much can be split. Okay. You can choose to split less than 50%. You don't have to split 50%. You can pick the number that is the best for your clients. And the important thing here, tax that is withheld from the source connected to the pension. So if the pension income that had the pension income amount attached to it that can be split, if it had tax withheld, then you're going to find out the percentage that's being split, and that percentage of the tax withheld will also move to the tax return of the receiving spouse. So that's very important because it is one of the benefits of pension income splitting. We're going to lower the taxes owing by putting the income on someone else's return, but if we put the income on their return, we're also going to put an equal portion of the tax withheld from that income on their return. Otherwise, the consequences on that return would not be good. Okay. You can go back 3 years. So if you should have done a pension split in the past 3 years, but you didn't, you can go back. But you have to remember there is a penalty for late elections. We'll talk about penalties in chapters 14 and 15. Penalty for late election is a set amount for every day that you're late to a maximum of $8,000 a year. So if you're going to do this and you're going to go back 3 years, you have to factor in whether or not the benefit is more than what the penalties would be if the penalties are applied. You also have to understand that because it's an election, if you need to do an adjustment to pension income, the government does not necessarily have to allow it. So if you have a client who did their own pension split and they made a really bad choice, you can ask for it to be adjusted, but the CRA does not have to say yes. We can't guarantee that it will go through because it was an election. We do, however, do a lot of pension income adjustments if we had to add income or take income off a return. So if we're fixing a return because something was missed, maybe we're changing donations, maybe we're changing medical expenses, maybe we're changing income that was missed or income that was overreported. Every time we do that, it is going to affect what should be the pension split as well. You can choose to leave the pension split the same, or you can do an adjustment for the pension split at that point. I find often those ones will go through, whereas someone who just picked a number and it wasn't a good number is maybe a little bit less likely to be accepted. And they're a lot of work. But be careful when you're doing an adjustment to a return that had pension income split on it. Remember that whatever you adjust on the return is going to also change the pension split that is optimal. Okay? Then we have to talk about the pension income amount. So when you do split the pension, someone who didn't have pension income might now have pension income. So if the lower income spouse did not have their own source of pension income, it's possible that when we do the pension income split, it might create a pension income amount for them. Whether or not it does depends on what group they're in. So if they're 65 or older themselves, the receiving spouse is 65 or older, they will get a pension income amount for that money. If they're under 65, but the reason that the income was transferred is because of death of a spouse, then they will get the pension income amount. If they're under 65 and not, then they won't get the pension income amount. Okay. But the fact that the pension income amount can be added to someone's return is one of the benefits of why we do pension income splitting. So I want to talk about that next. What are some of the reasons why you would choose to do a pension income split? So I'm going to ask for some suggestions, and then I'm going to go through and give you my answers. Why do we do all of this work? Because it is difficult. T1032s have lots of moving pieces and they make us add all kinds of things and make changes to our tax returns. Why do we do it? So Judy, the older person could die sooner. That's not so much going to be an issue for the pension income split because the pension income split isn't a real transfer of money. It's an on-paper transfer of money. So it doesn't actually mean they get the money. It means we just report the income on their return. But the fact that both people might receive a pension income amount when they wouldn't, that is beneficial. So think about the fact that you have one person, and let's say they have $100,000 of income from pension and investments. A good chunk of that is going to be pension income. That $100,000, they will get a $2,000 pension income amount, and they'll be in a high tax bracket. If I can transfer a big chunk of that to another person, in that circumstance, first of all, their tax bracket's going to come down. The other person will have to pay tax they didn't have to pay before, but all of the $100,000 will be taxed at a lower rate. And then, well, not all, but the top portion of it will be taxed at a lower rate. And then both of them will get a pension income amount. So now I'm going to take the same $100,000 that used to have a $2,000 credit, and now we have two $2,000 credits. So that's a benefit. Okay. And so the older person may not have had much of a limit. In this case, it's more a question of what thresholds are we worried about. So thresholds, if they're in a high tax bracket, we want to reduce their overall liability. But also think if they're in a high tax bracket and they're receiving old age security, what happens to their old age security? It could get clawed back. If we can take a chunk of that income off their return and put it on their spouse's return, they may not have an OAS clawback. Maybe they had too much income to get the age amount, but if we take a portion of that income off their return and put it on their spouse's return, it may increase their age amount. So there are lots and lots of things that will be affected by pension income splitting, and all of those things might be reasons to do it. So remember, you don't always split from the high income person to the low income person. Think of a scenario where both of them have equally high incomes, but only one of them has pension income. If that person has pension income, they can split $2,000 for the other person, and then all of a sudden, that $2,000, you're getting another $2,000 credit. So you're now going to double your $2,000 credit. It's worth the extra income on the higher income earner's return, and then the lower income earner also gets the benefit. So there are lots of times when you might do a small pension split just to benefit from a few of these other things that move, just to get it down far enough to keep the OAS clawback from kicking in, just to get it up high enough to double that pension income amount. There are lots of different options. Again, we're not going to do this by hand. I wouldn't want to have to do this by hand. But when we do it on a tax return, we have to be able to look at it and say, is this actually beneficial and why? So I will show you that when we do the software, how to look at it. Okay. Now, there are some reasons why you might not want to do the pension split. So the drawbacks of a pension split, it might cause an OAS repayment for the person receiving the pension. So if you split too much money to your spouse, you might trigger an OAS clawback for them that you otherwise wouldn't have triggered. It might reduce their age amount, which would be less good for the family as a whole. It might reduce their spouse or common law partner amount. Maybe the non-refundable credit is more beneficial than having the deduction of the income coming off. The one I want you to remember the most is the last one. So when you do a pension split, you're not actually giving the person physical money. They don't get to put the money in their bank account. It is entirely on paper, but the problem is the paper that it's on is the tax return of that person. So what are some of the benefits that exist in Manitoba for low-income seniors that are tied to their net income? And I want to think beyond the tax return here. So we're going to get out of the tax return completely and start talking about other services that we have in the province for seniors that are tied to income. What if they don't have health insurance and they have low income? What services can they access there? Things like pharmacare, rent assist, social assistance. There might be housing rebates, so maybe they're in a nursing home and the amount they have to pay for their care is on a scale, so they only qualify for assistance with nursing home fees and higher care costs if they have a certain income. What would happen to your client if that is the income that they have actually, but when you do the pension split, you go over the threshold for their program? You might save them a couple $100 on their tax return, but you might lose them thousands of dollars in government assistance. So if you're going to do a pension split, before you do the pension split, ask your clients, are you receiving any services that are based on your income that you can't afford to lose? And if they say yes, ask them what the limits are, because if you split it over that amount, you have really created a problem for your client. Okay, so make sure you factor in not just the tax return we do pension split, but your client's entire life. What else do they need? What services are they receiving? And then remember, you don't have to elect to split 50%. You can choose to split less. You can split up to the dollar amount, but not over the one that will trigger a problem for them. So I really want you to think about that when you do it. Okay, show you really quickly a T1032. You can look at these online, or if you want to, you can also do it in the textbook. The textbook, I would say, has a really good T1032. Sorry, my computer is not letting me get into where I want to get to. I'm going to try opening another window. I have a little toolbar at the top so that I can direct what you guys are doing, but sometimes it covers up what I need to click on. So I'm going to do it this way. What the pension split looks like is here. I, again, highly recommend the illustration in the book as what you're going to look at, because it fills it in for you and shows you what it looks like. The identification is always the person who's taking the money off their return and giving it to their spouse on paper. So the transferring spouse goes first. The person receiving the transfer in this year goes second. And you're going to have to do one for each of their returns. So you're going to be doing double copies of this one for each. The maximum part you're going to calculate on a worksheet. So to find out how much they can split, maximum, what is all the income that is eligible for the pension income amount, calculated on the worksheet, it goes on this line. Okay. And then we have the box for the retirement compensation arrangement. So if you see an RCA, that is the box you're going to use there. Go back to your textbook and follow the rules. Then it's going to ask for the marital status change. So if there was a portion of the time when you were not together, when you were separated, or you had not yet become common law or had not yet gotten married, or the portion of the year where you were widowed. So any of those things, they want to know how many months you were actually married out of the 12, and then you're going to prorate how much you can get out of the 50%. Then you're going to decide how much you actually choose. So you can't choose more than the maximum split pension amount, but you can choose less if you want to. You're going to calculate the income you're transferring to your partner. That's the amount that's going to go pension income amount. Okay, and then, so if they're going to get a pension income out of this, you're going to calculate it there. Then you're going to calculate the pension income out of the receiving spouse or common law partner. Then you're going to calculate the portion of income tax deducted. So how much of the tax withheld from that income is going to go together with the income on the return. Okay, and then at the end of the day, you should now have a number of different line numbers, because what you're going to have on the person who is transferring the money is any changes to their return related to that. They're going to have all the income reported, and then they're going to have a deduction. And remember, you're going to reduce the tax withheld from the amount on the slips based on the percentage. And then on the receiving spouse, you're going to add into income the pension split amount. and you're going to add into tax withheld, and then you're going to also adjust any of the other credits that you need to adjust. So pension income amount, if they now get one, you're going to add that in and follow through. Okay? So it's a busy form, and they both have to sign at the bottom. Last thing for this chapter, installment payments. So remember, we've been talking about this whole chapter. A lot of times when you retire, you have to pay. If the amount you pay is less than $3,000 each year, you don't need to do anything. But if you start owing more than $3,000 multiple years in a row, the CRA is going to do something called installment payments. It's going to require installment payments because they know that you're keeping more money than you should be all throughout the year and paying it back at the end. It makes it harder for them to collect tax from people, so they want to collect it up front. Just like you have an employer who withholds tax off of your employment income, and then you get a refund at the end. If you are owing every year, they're going to require you to pay some of what they think you're going to owe next year in advance, and that's how they calculate installment payments. So how do we know that a client might need to pay installment payments? What is the first trigger you're going to see on a tax return that tells you you might need to have a conversation with your client about this? You've finished the return, you've looked at the end of the return, they have a balance owing of $5,000. As soon as I see a balance owing of $5,000, what should I do next? After I've made sure that it's correct, but I've made sure that it's correct. What's the next step? Ask if they owe from previous years. So Judy, how will they know the amounts? They probably won't. People never remember. You will have access to represent a client if they are your client, or if they're not working through H&R Block or you're not working through H&R Block, you're going to ask to see their last 2 notices of assessment. So you can get the information from the client. If they have My Account, they can show it to you. If they have their notices of assessment, they can show it to you. If you're working in an office, you go in to represent a client and you look at the last 2 years. If in the last 2 years, in either of those years, they owed $3,000 or more, now they need to pay installments. So you need to tell them they need to pay installments, explain how it works. Okay. We don't necessarily calculate the installments for our clients officially. We give them estimates because we might not have exactly the same information that the CRA does when they do their formal one, but we can give them a really good idea of what they should pay. And then a little bit after, I would say a week or so after they get their notice of assessment, they're going to get another letter from the CRA that tells them you have to pay installments and this is how much we want you to pay. If you don't pay the installments, you will have to pay interest for every day that you're late or for the amount that you underpaid. So if you paid a little bit but not enough, they'll charge interest on the amount that's underpaid. If you don't pay it at all, they'll charge interest on all of it. Okay, and then if your interest is over $1,000, they'll charge penalties on top of that. So there can be penalties as well as interest for late installment payments. The penalty is 50% of the amount of interest payable minus whichever number is bigger, minus $1,000 or minus 25% of the interest that would have been payable if no installments had been made for the year. We don't calculate that. And that's why when I tell my clients this is what I'm estimating, I tell them estimate because I can't factor in if there's going to be an interest or penalty portion to that. I can only guess. But I can give them a rough idea of how much they should be paying and when. Okay. Now, there are 3 ways of calculating what you should pay for installments. One is the current year method, which is essentially just pay the same amount that you owed this year in 4 payments. One is the prior year method, which is using the totals from the last year. And one is the CRA installment method, which is March and June installments are based on income from 2 years ago. September and December installments are based on income from last year. If you don't know for sure what their income is going to be next year, the safest option is to do the installment reminder method because that's what the CRA wants them to pay. And so even if after they pay those installments next year they still owe some tax, there won't be additional penalties. If you use the other sources, if you use the other methods, current year or prior year, and you get it wrong, and next year they owe more, then they will be penalized for anything that they would have had to pay under the installment method. And so if you don't for sure know what their income is going to be for next year and you can't pretty much guarantee it, the safest thing to do is use the installment reminder method. However, sometimes you do know what it's going to be. Sometimes it's very clear, nothing is going to change, everything is fixed, you can calculate it pretty much to the penny, and it will be better for them to do one method or the other because they can pay less upfront. They'll get a smaller refund, but they won't have to lose as much money throughout the year. If you know for sure, you are allowed to use either the current year method or the prior year method. It's just risky because if you do get that calculation wrong, then you're in trouble. Okay. And again, there may be a circumstance where a client is asked to pay installments, but they don't have to pay them at all. Again, very risky if you do that. But I've had that happen with some clients where they owe every year because they have small businesses. And when you have a small business, you usually end up owing tax. And then they've now incorporated, and next year we've set up payroll for them, and they're not going to owe because now they're being employed by their corporation, and their corporation is doing installment payment, is doing withholding, tax withholding, and all the things it usually does, CPP, all of that stuff. So if you can 100% guarantee that your client is not going to owe next year at all, then they don't have to pay installments because the penalty is what they owe and they don't owe anything. But that is super risky, so I wouldn't do that without talking to a senior associate and the client and making sure the client is aware that it's risky. The best advice is let them know they're going to have installment payments that they have to make, and recommend you can calculate what the installment reminder method would be, and then tell them this is an estimate. When you get the letter from the CRA, follow what the letter says. Make sure you make those payments. Don't miss them. If you're late, there will be interest. If you're very late and the interest is high, there will be penalties as well. Okay. How do they make installment payments? They can use an installment remittance voucher. If they have my account, they can ask for a personalized installment remittance voucher called an INNS3. Okay. If you tell your clients and they're confused, tell them to look somewhere on the right side of their My Account screen that has a button that'll say either make a payment or remittance vouchers, something along those lines, and you should be able to find it there. The trick is to make sure that it's going into the right tax account. So at the CRA, they have different accounts. They have one account for current year taxes owing. They have an account for old tax debt, and they have an account for installment payments, which is tax you're prepaying for next year. And the three departments do not talk to each other. So if you are supposed to be paying installment payments, but you're putting it into an account for old taxes owing, and you don't need to because you don't have old taxes owing, that department will hold on to it for a couple of months, and then will go, hey, you don't have any taxes owing, and they'll give it back to you. And in the meantime, the installment people are going, you're late paying your installments. So make sure your clients know that it is an installment and it has to go into the installment account. They can do online banking. It'll be the same. You set it up, you set up a bill for the CRA. You're going to see 3 different options for the CRA bill. Make sure you look for the one that says installments or future tax, something to that wording. Every bank may have different wording. Make sure they know it's going into paying for next tax year. And then they can do online payments through the CRA My Payment program with the Visa Debit, MasterCard, or Interac Online. They can do pre-authorized debit, but we can't do that for them. That has to be paper filed, so we don't do that for our clients. But if your client wants to paper file, they can set up pre-authorized debit through that. And they can do credit cards, so just like you can pay through your bank, you can also pay through your credit card if you want to. Same problem, make sure it goes into the future account. If your client has paid installments, that will go on their return in this kind of the same way you had tax withheld at source. So you had tax withheld at source, you get a credit for it at the end of your tax return. Anything you've paid in installment payments will be on line 47600. At the end of the return, you'll get credit for it. How will you know how much your client paid in installments? How will you know what to put on line 47600 of the return? So Kendra, you can ask them. The problem with asking them is they get mixed up as to what they put in last year or what they put in future years. So they're not very reliable. I wish that they were. In the old days, that was pretty much the only option we had, but it's not reliable. Look at their My Account. Look at your Represent a Client. That will have the information on it. It will tell you this is what is available. And in fact, when you do autofill My Return, when you do your download of everything from the CRA account, it will also be in there for you. That is the number you have to take. I have had situations where clients are sure they paid their installments and nothing is showing up on their file, and we've had to go get it sorted out before we can file their return. If I had put it on the return without checking, it wouldn't have been allowed, and they'd have a big tax debt, and they would be very upset. So sometimes they're not sure what they paid or when they paid it or where they paid it. They think they know what they did, but they don't really know for sure what they did. So if we have to track it down, we have to track it down. But always look at the My Account or Represent a Client for installment payments so we can make sure that whatever we put in, the CRA will accept. They will agree with it. Good. That's it for this chapter. So we're going to take a short break. So it's 10:21 now. We're going to come back and we say 10:27, and we're going to jump into the next chapter. I'm going to do my best to finish the entire chapter 12 as well. Okay, so take a break there.